to go to the United States to go there, sorry, to get the investors to invest in your company. There has to be a rationale behind. If there's no rationale behind, don't do it. There's now another reason to do it is that if you're selected by a local accelerator or incubator like Y Combinator, Y Combinator usually requires the selected company to be US or become US before they join the program. They're not the only one, but there are others like Plug and Play who will not ask you to do that. And your Plug and Play also has representative offices in many, many European cities. So you have to flip your company into US, you will either do it because you have business over there and your market is over there, or because you want to be there to be aware of what's going on. So what you need to do to flip your company into a US company, we have imagined a scenario where a company called TECHCAP has decided to flip over to the United States, and we're going to go through the process of that company flipping over. So the TECHCAP is a 10-year plus company, French SAS, as we say, translated as Simplified Joint Stock Company, but basically it's a company, with public company with shares. It's an Inc. if you want to compare it to US standards. It has financial investors and corporate investors, and the rest is split between business angels, founders, and management. The company, as I said, is willing to develop its activity because the market is mainly US, and is willing at the time of the flip to raise between 5 to 10 million US dollars. Investors are accredited investors under US securities law, and there is a general agreement that the company has to flip. But as it is usual for lawyers, we do represent TECHCAP. We don't represent the shareholders of TECHCAP or any other kind of security holder, option holders, any individual shareholder, unless, as is said there, we have been advised to do so. So there are two ways to complete a flip. The first one, and the easiest one, and the most popular one, is to incorporate a company, NewCo, in the United States, and well, usually in the state of Delaware, because most of you certainly know that Delaware is the state where you want your company to be incorporated, because it has the most sophisticated and extended case law system, and therefore most cases have been already judged, and there's a precedent so that it is easier to know the rules. And you have to remember, for those that are coming from Roman law, that in the United States, like in any Anglo-Saxon legal system, the law is more based on case law than on laws, and there is no codification. So there's no set of rules like we have in Roman law countries, to which set of rules that you can refer to when you have a problem. The other scenario is to use a subsidiary that the company has been operating for either testing the market or, as I said, to have a presence on the ground to see what's going on and if there are opportunities. This is a more sophisticated process because you need to exchange shares of the parent against shares of the sub, which forces you to cancel at the same time the company receives the share. You have to cancel the shares at the same time. So there's as I said, it's more sophisticated because you have to be very careful about the agenda and the timing. So usually, even if you have a subsidiary, you will go for scenario one, and at some stage you will just merge. You will have you have the new co, and the former US sub will become a direct sub of the new parent, the Inc., new Inc., TECHCAP US. So yeah, the one of the problems that we have faced in France, but I guess it's a problem that can be met in many other countries, is that usually in France for tax reasons, or because the funds are subject to a specific legal and tax regime that forces them to have a certain, or not to exceed a certain percentage of their investments in foreign companies, then they are reluctant to invest directly in a US company, and therefore they're reluctant to exchange their shares in a French company against shares of a US company. So either individuals have tax reasons for, and I think it's I think I'm already, yeah, okay. Yeah, sorry. I mean, I'm just, I was ahead of time. I'll come back to that. But I mean, the exchange of shares is pretty simple. You exchange ordinary shares against ordinary shares in TECHCAP US, and you will exchange preferred shares of TECHCAP France against preferred shares in TECHCAP US, basically with the same features as the existing one, and only with the adaptation of the shares into a different system of law. But that's pretty boilerplate. So, and the rights that are incorporated in the shares are pretty, again, boilerplate. So it's usually not a problem. The flip qualifies as an offering of security on the US territory, so that you have to abide by the provision of US security. Anti-fraud will impose corporate and personal liability of the management for any untrue statement. And yeah, I mean, it's basically, I mean, the consequences of that is basically you will do what you do in case of financing, where for the reps and warranties, you will disclose everything that may be problematic, and it's the same system. You will declare as much as you think it is useful or put you at risk. Again, because preparing an offering memorandum is pretty expensive and forces you to recruit and use an investment bank most of the time, and also because the offering as such will be restricted to the existing shareholders of the company and the new investors. usually in most cases you will skip that obligation and take the risk, which is then really minimal. Again, the second aspect is that you will need to comply with the private placement exemption, which are usually referred to as Reg S or Reg D. This again will force you to disclose, but there again, it's the same exercise as would be, because you will raise money at the same time, the reps and warranty exercise that you have to carry for the new investors. So as I was saying earlier, some shareholders will not be in a position or not willing to exchange their shares on the spot individual, because, for instance, in France we have a specific instrument called PA, which is a portfolio where you put the portfolio companies, and against an exemption of capital gain, or you had in the old days when we had a
wealth tax.
What?
Wealth tax.
Ah, wealth tax.
Wealth
yes.
Tax.
Yeah. Thank you, Jean. Then people were investing to partly pay their tax, and you have the same regime for the IRPP, Jean.
Income tax.
Ah, income tax. Sorry. So you can pay part of your income tax by investing in private companies. So, and this will trigger for you an obligation to keep those shares in that particular company for a number of years. To solve this difficulty, we are now used to put what we call a put and call agreement, whereby the investors the existing investors have the right to exchange their shares against shares of TECHCAP US at any time, and TECHCAP, sorry, it's a bad name. TECHCAP US has the right to require the exchange if there are liquidity events like IPO or trade sale, or what the US call merger, or if the shareholder breaches the investment agreement or the shareholder agreement. And in such case, the sanction, the penalty will be that the exchange for US shares will be forced. And this is a very strong threat, because especially for the funds that I mentioned earlier, because of that they cross the threshold, it disqualifies their entire portfolio, and therefore they would be subject to capital gain. And by consequence, their LPs would be absolutely mad and probably sue them for damages. So as far as funds, it's a very strong argument.
Are you talking of French or American? You're talking about French investors here.
Well, any fund that has thresholds to comply or to abide by for tax reasons, to be placed under a certain tax regime, any fund that breaches those obligations would be subject to the same penalty. It is true for French funds, but any fund that is subject to investing, for instance, in Europe, because the French fund may invest in European countries, EU countries, but certainly not non-EU countries like the United States. Does this answer your question?
Yes, thank you. Please go on.
So the put and call will be executed by, as I said, holders of existing securities. and except for bonds or warrants, and also to stock option holders. And there's a reference here at founders warrants, the SPC, which is very specific French instruments, or any other warrant holder that would be warrants that would be granted, for instance, to board members or consultants, when the local law does not allow you to grant them stock options directly. Like in particular in France, you cannot grant stock options except to employees of the company. So if you want to grant any kind of instrument to consultant, then you have to go for the warrants. So, as I mentioned earlier, and you can see on that slide, the new financing round will be completed at the same time as the flip is completed, so that you are certain not to flip your company and have no money, because, as I said, and we'll see later, this would be a very bad move. Sorry. And to complete that round, all the existing and therefore new shareholders of the TECHCAP US will enter into a US preferred stock purchase agreement. As I mentioned it, also under sometimes those French investors that have requirements not to invest above a certain percentage into foreign company will request to invest in the French company, and therefore make their new investment subject to the put and call option agreement that I mentioned earlier. It is technically possible, like many things under legal under legal system are possible, but it's not always something you want to do. In this particular case, if you can avoid it, because it really makes the situation and the management of the situation much more complex. But I've done it, and it does work, but it's pretty heavy to operate. So the shareholder agreement the existing one will be, of course, amended so that only and actually will be so it will come to its term, to its end, because there'll be only one shareholder in the company. Hopefully, TECHCAP US will be a 100% shareholder of TECHCAP France, and mosquito. The existing shareholders that have exchanged their shares will execute an amended and restated shareholders agreement in TECHCAP US. Like the preferred shares that I mentioned earlier, the shareholders agreement will be set to replicate what was in the French shareholders agreement, but because we're in different systems of law, and in particular in a system of common law, there will be changes and modification required, so that it makes the shareholders agreement friendly for the new coming investors that in general will be local investors, Californian or Boston or whatever. And as I mentioned, the reason I'm saying that is that the practice slightly varies from the East to the West Coast. Not much, but you have different habits. voting is usually the same as in most systems. It's one share, one vote. But if there is a need to, because some shareholders have remained in the French subsidiary, the provisions regarding the voting of the French shares will be contained in the shareholders agreement, and this would be if there was a breach of those rules committed by one shareholders that remained in the French TECHCAP France, then the call option could be instrumented. The remaining shareholders do vote, and it's for at least again for the Roman law countries, it's a bit odd, but they vote in the US parent on an as converted basis, i.e., if they have, let's say, to exchange 2 shares of the French TECHCAP France for 1 share in the TECHCAP US, then they will have 1 vote per 2 shares in the French sub, 1 vote in the
I have a problem hearing you, Olivier. Am I the only
stock
one?
option plans.
Oh, here you are. Could you do the previous slide again? I could not hear you. I don't know about the other persons on the webinar. Yes, if you could do that again.
Yeah, well, again, this is what it says here is that when you have shareholders remaining in TECHCAP France, the provisions regarding their voting, the voting in in TECHCAP US will be contained in the US shareholders agreement. And what I was saying is that it is in particular if one of those shareholders would breach the rules applying to the vote, that the TECHCAP US could enforce the call option and force the shareholder to exchange its shares against US shares. And as I was saying earlier, for a fund, this might be dramatic. So usually those provisions are very well complied with. And those shareholders will vote on an as converted basis, which means that let's say they had to exchange 2 shares of TECHCAP France to get 1 share in TECHCAP US, then they will get 1 vote in TECHCAP US for each and every 2 shares they have in the French company. Did you hear that well?
Yeah.
Okay. So yeah, stock option plan. Well, this is a topic that is also have to be thought about, because I mean, well, I don't know, because there are countries in Europe which do not have a specific tax regime for stock options, but UK has, France has, and you will then have to implement a US stock option plan, because the parent and the ultimate holder and controller of the group will be a US company. US stock option regulations do not differ very much of the local European ones, but nevertheless, there are slight differences between the two, so that the company will have to prepare I'm sorry, I'm going to have to move because my phone is getting out of battery, and if I get out of battery, you will not hear me at all. So just hold on 1 second while I'm moving. sorry about that. But in the two plans will have we're
Okay, Olivier, we cannot hear you from your new place. We cannot hear you at all. Olivier? Well, yes, I fear that this webinar will have to end here. We shall put the PowerPoint at your entire disposal, and you will be able to follow. Oh, are you back, Olivier?
Yeah, I'm back.
Okay, so could you share your screen again? Hello? Hello? Can you hear me? Well, apparently lockdown is having the best of Olivier Edouard's connection. Oh, here we go.
Okay.
Okay.
Sorry.
I was being pessimistic. Welcome back, Olivier.
Well, I'm sorry. It's the the interest of being confined. I mean, you have to move around the house. Yeah, as I was saying, the new U.S. stock option plan that you will have to put in place will have to comply with the two sets of rules that apply to. One, of course, is the U.S. Set of rules, but the other one will be the set of rules applying in the country where the employees will be tax residing. So, of course, naturally, because you have a French sub in the case that we are studying, then the French tax employees residing in France, tax-wise, will have to be governed both by US rules and French rules. Fortunately, most rules are common, but there are slight differences. So you'll have to refer to lawyers that are familiar with both systems. And I mean, this is about all. Yeah. IP is another subject that you will encounter. I mean, just coming back 1 minute on the stock options. Of course, the options that have been already granted will remain valid, and capital gain usually, I mean, in most tax systems are taxed locally in the state of tax residence of the beneficiary. So that if you're French employee tax-wise based in France, then your capital gain rule will not change, whether the option have been granted by the French former parent or the US new parent. Now, IP is another subject that you will have to face and deal with. I would say a number of years ago, the US investors were pretty nervous about the IP assets, as you can imagine, because it's usually what the company is about. And it is really the heart of the business in most cases. And they absolutely wanted the IP to move up to the new parent. And this had to be, of course, planned and considered prior to the flip, because they would not invest unless the IP was in the new parent, in TECHCAP US. Now, this has changed for well, two reasons. The first one is that because the company usually flipped when it had some business, the IP had also a rather significant value, and therefore the transfer was generating profit in the French company, TECHCAP France, and was most of the time set off from the losses, but in a way, and it seems a paradox, but it is true that they, in such case, you are using your losses for no purpose, and the so-called benefit of your losses is lost. In other words, it means that you will pay income tax, company corporate tax earlier than you would have without the transfer. And in certain cases, it would just trigger a corporate tax because the company didn't have enough losses to be set off against the profit made by selling the IP assets. So that was the first difficulty. And the investors finally admitted that if the TECHCAP US was holding or controlling through put and call options 100% of the shares of the TECHCAP France, then the risk was nil. And the other reason that really achieved and terminated to convince them that it was not always a very good idea to move the IP into the US is the so-called anti-inversion rule, which will set a tax and rather significant tax on the value of the assets that are on the US territory, and you want to move out of the US territory. And of course, the purpose of this rule is to prohibit, without saying it, the transfers of IP outside the US. And this is why you have a lot of IP, for instance, that you will find in Irish companies, because mainly the GAFA, for instance, will not be willing to bring these IP assets back to the US because they know that they will not be able to move it out again. And this is also, as you will understand, a very strong difficulty if you want to unwind the flip. Because if you have flipped the company over, moved the IP assets into the US, well, if you want to de-flip, it means that you will need to send the assets back to the French company, and then the anti-inversion rule will force you to pay heavy taxes. So in most cases, you will just keep a US parent for no purpose at all, but just because you're not able to move the IP back to, well, France, or in this particular case, but it could be Spain or, or Germany in the future. And this has happened several times. I mean, anyway, if your investors are still willing to move the IP to the US, it will be done either by a mere sale, which is the reason why you will have a profit made by the French company, or more frequently was also done by executing a license agreement whereby all the rights on the IP were granted to TECHCAP US, and for instance, the rights would remain for TECHCAP France to operate the IP rights on the French territory, for instance. Well, again, this is what I said earlier. A number of companies decided to move the IP to a low tax jurisdiction like Ireland or Luxembourg. This has been done a number of times as well. I even had a case where the company was flipped to Luxembourg because the US investor did not want the company to be based in the US because the money he wanted to invest was outside the US territory. Therefore, he didn't want to repatriate these funds, so he needed to invest them outside the US. And also he wanted to be in a low tax jurisdiction. So finally we flipped the company to Luxembourg, and the US investor invested in a Luxembourg company. Or you can, you can decide to wind and liquidate the TECHCAP France, and in our system, there's a very simple way to do that if you own or control 100% of the shares. Yeah, well, I think I already dealt with that. I mean, the tax consequences for if you want to sell IP rights based in France, you will have to bear a transfer tax or registration duty of 5% of the purchase price, and also you will have to bear the corporate tax on the profits so made. And as I already mentioned, you can offset that against NOLs carried over if there are, and usually there are. But again, you will lose the benefit of those NOLs for the future. Well, license agreement, yes, royalties will be received by TECHCAP France, and again, set off the NOLs carryovers. Yeah, well, there are specificities, but again, this is a sort of rather general tax rule. If, because of the move of the IP, the activity of the French, or I would say any other EU former parent, if this triggers a change of activity, then you cannot use the existing NOLs versus the corporate gain or the profit, because you are not allowed to offset losses. But I mean, you can offset, sorry, I'm going to say it another way. You can offset losses only against comparable profits, or profits against comparable losses. Well, I mean, this is, yeah, as I said, yeah, the dissolution of TECHCAP France is not a very good idea, as I quickly said before. because this will usually trigger severe tax consequences. When you liquidate a company, you pay taxes on the profit that are distributed to the shareholders. So that usually you just don't want to liquidate a company, and also this would immediately transfer any liability to the parent, which is also something you don't want to happen, because the US investors are not very familiar with the existing liabilities in TECHCAP France. And finally, usually the former parent still serves a purpose, like acting to sell the product, or like in France you have rather favorable state financing of R&D, and you usually then, if the former parent is a French company, you will usually keep the R&D team in France because you will receive tax credit. So if you are an individual and you are about to flip your company, there are a number of things that you have to check. It's well, as it is mentioned here, capital gains. Well, usually again in the EU you will have a specific exemption that will postpone the capital gain realized upon transferring your shares or exchanging your shares against shares of the US, so that the capital gain will not be taxed upon the exchange, but will be taxed upon a liquidity event. Well, wealth tax, this doesn't exist anymore in France, certainly not for shares. So this is no longer a concern, but it can be a concern for other EU countries. And also you have this, in France you have the exit tax, because they want to avoid French citizens to move away, except for a number of selected reasons. In this particular case, if the company is flipped and for instance, the CEO, the founder, has to move to the US, then this will constitute an exemption to the exit tax, but the filing has to be done well in advance to be sure that the exit tax will be exempted. I mean, the CEO will be exempted from the exit tax. So, basically, what it boils down to the fact that the flip is a relatively complex and time-consuming and money-consuming transaction, so that you have to do it only for good reasons. Therefore, you have to carefully consider the reasons why you do it, and especially because, as I mentioned, it is easy to flip, but very difficult and expensive to deflip or unwind a flip. And also, one thing that I did not mention that is also true is that it will take a lot of time and pedagogy vis-a-vis the existing shareholders, especially if you have a number of a lot of business angels. You'll have to spend a lot of time explaining the changes from their existing legal system to the US legal system. Probably easier for a UK business angel to understand, but I can tell you by experience that French business angel can be quite difficult in those circumstances. They're very prudent, and they don't, they are not very, they do not trust you very much. So do it when you have to do it, but carefully consider before doing it. can read what I can read before the undecided consequences should be carefully ascertained and considered. And I think this concludes the presentation and opens the floor to Q&A.
So for you, valiant that remained till the end, because we lost, I fear, a few when they were during the interruption. Are there any questions you would like to put to Olivier Edouard? I'll try the first one. Maybe we can break the ice. Are there particular points to be to take care of if the company is listed? Would you advise to delist it first or to go for a double listing?
Well, let me say that you would not consider listing a double listing as a flip. First, because I mean it is easier to go for a double listing from a US market to a European market, and especially the French market, which is the one I know, because in the United States, when you list a company, you list a number of shares. And this is why in many shareholders agreements, you will find what they call piggyback rights. So that, because listing a company is expensive in all countries, but especially in the United States. And therefore, the investors want the company to pay for their listing expenses. And if there are further listings of shares, they want to be able to benefit of this new listing of shares. And again, this is because in the United States, you list, if let's say your company has 1 million shares, you will put on the market 300,000 shares, no more. The rest will not be listed. If you list a company on a French market and you have 1 million share, the 1 million share will be listed. So it is more complex to handle a double listing stemming from France to the NASDAQ, for instance, than it is to go from the NASDAQ to the French market. So it doesn't really answer your question, but when you flip 100% of the shares. You don't flip 30% of the shares.
Okay, thank you very much. Are there any other questions, ladies and gentlemen? Well, thank you very much to everybody. We shall do a general emailing, a general newsletter with all the webinars when they are on the website. Thank you again for everybody. Goodbye.
Goodbye, my friend.